Hello, and welcome to the Credit Compass, your guide to navigating European credit markets. Well, things just got volatile. What a start to the year. And while this volatility is likely to be an ongoing theme throughout 2026, investors are best served by looking through the noise and focusing on underlying economic performance. There will be no shortage of headlines coming out of Davos this week. Given the rhetoric, much of the coverage will focus on trade and tariffs. But on today's podcast, I want to focus on some of the more positive signals emerging across Europe. All right, let's dig in. First up, Mercosur. We discussed it last week. The agreement was signed over the weekend, so it's finally here, or almost. One final hurdle remains: the European Parliament. Lawmakers are still somewhat divided, with recent polling suggesting the outcome is on a knife edge. There is still scope for the ratification process to be slow-walked through Parliament, potentially delaying implementation. However, given the escalation in trade tensions with the U.S., political pressure is building to move this forward more quickly. The first key step is a vote on Wednesday on whether to advance the agreement to the next stage or refer the text to the EU's Court of Justice for review. Assuming it is not sent for judicial review, the deal will then be debated and voted on over the coming months. In theory, the European Parliament could delay implementation for up to 2 years if it chose to. Let's hope lawmakers recognize the mutual benefits on offer. Meanwhile, trade tensions with the U.S. are escalating, most notably over Greenland. Our base case is that this reflects a familiar pattern of escalating threats on both sides, followed by de-escalation towards a negotiated outcome. What feels different this time is Europe's posture. In contrast to last year's trade agreement, Europe appears more emboldened to take a firmer negotiating stance with the U.S. administration, perhaps supported by the Mercosur deal and broader trade diversification efforts. We'll have to see how this develops, but we're hopeful that the in-person meetings around the World Economic Forum in Davos will help to cool tensions. Now, to the numbers. Let's start with the UK. November GDP growth surprised to the upside, and it caught me and many market commentators off guard. This is especially notable given the uncertainty created by the Treasury in the run-up to the end-of-month budget. Actual GDP growth came in at plus 0.1% versus expectations for a contraction of 0.2%, a 3 percentage point upside surprise. The prior month's decline of 0.1% was also revised up to flat. Industrial production significantly outperformed, rising 2.3% versus expectations of a 0.4% decline. Manufacturing output increased by 2.1% compared with forecasts for a 0.3% contraction. Broadly speaking, these are strong numbers relative to expectations. That said, it wasn't all roses. Services growth was modest at just 0.2% over the 3 months to November. Construction was weaker than expected, with output down 1.1% year over year. Overall, the data point to stronger than anticipated momentum at year-end, positioning the UK relatively well as we move into 2026. The interest rate backdrop is also improving. Rate cuts are increasingly expected in the near term, and recent data reinforce that view. Earnings data show a deceleration in wage growth, one of the key concerns for more hawkish members of the Monetary Policy Committee. In addition, a softening labor market further supports the case for near-term easing. Interestingly, the decline in payrolled employees contrasts with the improving growth picture. But this divergence points to rising productivity, more output being generated with fewer workers. The Resolution Foundation has highlighted that payroll-based employment data, rather than the ONS labor force survey, suggests a meaningful productivity improvement is underway. They attribute this, in part, to creative destruction. Higher interest rates, elevated energy prices, and rising wage costs have led to the collapse of so-called zombie companies, clearing out low-productivity firms and shifting the corporate sector towards more efficient operators. UK compulsory liquidations rose to 3,730 in 2025, the highest level since 2012, according to the Insolvency Service. However, total insolvencies were broadly unchanged from 2024. Importantly, the insolvency rate remained stable at 52.5 per 10,000 companies, equivalent to a default rate of roughly 0.5% from a credit investor's perspective. While high levels of liquidations are not ideal, if the Resolution Foundation's thesis holds, the removal of unproductive firms could provide a healthier base for growth in the year ahead. Now, let's turn to continental Europe. Last year, there was a lot of discussion around German government spending plans, when they would materialize, and why they were taking so long. For much of the past 2 years, Germany has been defined by a struggling industrial and automotive sector, weighed down by China's slowdown, increased competition, and regulatory burdens. But sentiment appears to be turning a corner. The latest ZEW survey, which tracks investor expectations for the German economy, showed a sharp rise in optimism. The index jumped to 59.6 in January, up from 45.8 in December, and well above expectations of 50. The strongest improvements in expectations were seen in construction, technology, and financial services. Next, France, the euro area's second largest economy. We've long discussed the challenges facing the French government in passing a budget, and those challenges have now come to a head. The government is pushing the budget through using Article 49.3, which allows legislation to be adopted without a parliamentary vote unless a no-confidence motion succeeds within a defined timeframe. The government revised several contested measures in an effort to limit opposition and avoid a successful no-confidence vote. So what's proving controversial? The budget includes an extension of surtax on France's largest companies and an expansion of taxes on higher earners. What was initially intended as a temporary measure has now been prolonged, frustrating businesses and high earners. The government is also pushing spending cuts to reduce the deficit to 4.7% of GDP, down from higher recent levels. Broadly speaking, the package still falls short of euro area fiscal targets, but it does represent progress towards consolidation. The adjustment comes via higher taxes on wealthier households, reduced tax rates, frozen income tax brackets, and spending restraint. The key question now is whether the government can survive any forthcoming no-confidence votes. Finally, in the background, we have a steady stream of commentary from Davos. This year's World Economic Forum has focused heavily on artificial intelligence and its economic impact. Against the backdrop of recent market volatility, many commentators are also revisiting valuation concerns and emphasizing diversification. PwC's chair highlighted findings from a recent report suggesting that roughly half of companies are not yet seeing tangible benefits from their AI investments. While adoption remains early, the report underscores how challenging it can be to fully realize AI's promised gains. It also notes that geopolitical uncertainty is testing corporate leadership and weighing on CEO confidence, particularly regarding growth prospects in 2026. So, let's bring this all together. The UK economy is showing more resilience than expected. Challenges remain, but the data point to improving momentum. Germany is seeing a notable uplift in sentiment, with fiscal support finally expected to gain traction this year. And if France can successfully push its budget through, that would mark another constructive step for Europe as we begin 2026. That said, a spanner has already been thrown into the works. Trade tensions over Greenland risk escalating further, and large moves in the Japanese bond market are rippling through global markets, erasing a significant portion of year-to-date gains so far. Periods of instability are likely to remain a feature of the year ahead. Valuations are elevated, spreads are tight, and risk assets are priced for optimism. But from a credit perspective, the foundations remain solid. Defaults are low and expected to stay low. Interest rates are low and expected to decline further. and European growth is showing early signs of turning a corner. Could trade tensions disrupt this outlook? Potentially, but not imminently. That's all for this edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It really helps others discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macro credit, our hub for macro, markets, and credit dynamics. Till next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.